Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Currently, if you are looking for a undervalued stocks in the S&P 500 or the Dow Jones and so on, you will struggle. And the reason I say that is because the S&P 500 is up 25% since beginning of the year. Although a lot of that is down to the Magnificent Seven or the technology companies, some of the other sectors have also done really well in 2023. So what I want to do today is I want to look at one single company that's actually undervalued a lot in my opinion, and I'm going to give you the information. But before we do that, I just want to talk about the fact that you might see quite a bit of volatility in the next few weeks because a lot of these hedge funds are now rebalancing their portfolios. So they're taking some money off the table, say buying new stocks and so on. So it's that time of year again where they do these things, and it's normal. Okay, so I wouldn't panic if I were you. In fact, the fact that the S&P 500 has not done well last couple of days, or generally the stock market hasn't done well last couple of days, is actually good for us. Okay, as you can see, my portfolio now is under £90,000 again. Although it's gone over 91,000, it came back down again because of what's happened the last couple of days. This type of things gives us an opportunity as a long-term investors. And I'll be honest with you, the technology companies, I do believe that they due for correction at some point, and correction means they can go down up to 20%. And if that happens, I'm happy to dollar cost average into some of the wonderful businesses that are in there. So what I'm going to do today is I'm going to talk about today Products and Chemicals. This is one of the companies that I've had in the portfolio for a very, very long time. As you can see, for the 1 year, it's actually down 11%. Now, in terms of the 6 months, it's down about 8.5%, it's almost 8.8%. And the company, in terms of financials, when we look at the revenue from in 2014, is actually had about $10 billion. And then it could decline about to 7.5, 8, 8.9, 8.9 again in 2019, 2020, 8.8, and then in 2021, $10 billion, then 12.6, then 12.6 again, and then right now that's where we are. So it's been, apart from a couple of years, it's been consistently growing. So from $10 billion to $12 billion in the space of basically 10 years. Okay, so it's not fast growing, but it is actually heading the right direction. Not every company is gonna do as well as the Nvidias and so on. Okay, in terms of net income, then less than $1 billion to right now $2.3 billion. So that's also growing in the right directions. Now, a couple of more things in terms of dividend side of things. They do pay you $2.58% of dividend yield. That dividend is safe, very safe indeed, 95%. The highest any company can get is 99%. So the market cap right now for this company is just over $60 billion, which makes it a large cap company. And a couple of more things in this one. Payout ratio right now is about 60%. It's slightly higher than I actually would like to, but I think it is coming down in the couple of years coming. So they're growing that dividend really nicely, because the latest increase was 8% and then 10% basically last 10 years, and last year basically 20 years was about 11%. Now, as you can see, that it's actually heading in the right direction, which is quite nice to see. They have increased the dividend for 41 years. So this company, in a few more years down the line, 9 more years, it will become dividend king. Right now, it's a dividend aristocrat. You get paid $7 for every share of this company that you own. And as you can see here, they have been growing their dividends every single year. Now, according to the dividend method here, it looks like it's undervalued. Okay. Because the current yield, sorry if I can unclick this, the current yield is actually higher than the 5-year average, which makes it basically attractive. And the current PE average, okay, for the last 5 years, is actually lower than the current PE, which actually again makes it is undervalued at the moment. So it's about 20. The material sector is quite low anyway, normally. In terms of earnings per share payout ratio, we've already seen base 60%, but the next year is actually coming down, which is nice. Okay, so it's nicer to see that it's actually coming down. Earnings per share is heading the right direction, is increasing every single year for the last 10 years from $5.78 to $13 is expected next year. Now, Couple of more things. Sales, shares outstanding, as you can see here, for the last 3 years, they have not actually, 4 years, they haven't bought any shares back yet, but they are actually buying slowly. Okay, total sales, we started in 2014 about $10 billion. We've seen that already to right now about 12, expected next year to about 12.6 billion dollars. We've already seen that in terms of revenue. Return on equity is about 16%, which is quite nice. Return on invested capital about 9%, and operating margins of 21%, and free cash flow margin of right now minus. Okay, so this is one of the reasons this company, I've not actually included I've not talked about this company for a while because of the free cash flow negative side of things, but that is actually going to change in the future. Net debt to EBITDA right now is actually below what we wanted, below 3 for the material for this type of companies, which is quite nice. So now we need to look at the valuation side of things. Okay, so according to Morningstar, it's about 14% discounted right now, $314 per share. I will tell you exactly, and using my own models, I will show you exactly what I think of this company and where I think it will end up in the future anyway. According to Simply Wall Street, is actually saying 41% undervalued at the moment. $464 per share is where they think the price should be. In terms of growth side of things, okay, in terms of growth, in fact, let me just talk about one more thing. I'll come back to growth. So it's a moderate buy from tip ranks. $300 per share is where they think the price should be, about 13% upside from where we are. Now going back to the growth side of things, next year they're expecting the earnings to grow about 9.6 or about 10%, and then about 10% every single year, which is really solid moving forward into the future, inshallah. Now, okay, let's go back to earnings and let's check the individual years. So 2024, they're expecting about 12% growth, 12.6 in fact, which is quite nice. 2025 is almost 10%. Then 2026 is about 15%. So even if we take this one, because there's 4 analysts looking at about 17%. So in terms of EPS growth, is going to really have a bright future, definitely. And then when we look at the growth side of things, or for the revenue, okay, 6%, 9%, 13%, 20%, which is absolutely huge if you think about. Now, in terms of ratings, okay, as you can see here, Seeking Alpha Analyst is actually saying it's a buy. Wall Street is actually saying it's a buy, and Quantity is actually hold. So let's have a look at Wall Street expectations. So strong buy is 10, buy of 5, and hold is 8, and 1 strong sell. Right. 14% upside from where we are. $308 per share is where they think the price should be for this company. Now, before I show you my final valuations, taking into consideration all the things that we have just seen, let's compare it with other companies. First, let's compare it with the S&P 500. Okay, so, and I want to focus on, in fact, I want to focus on total return rather than just the price itself, because this company does pay some dividends, right? So if you look at the last 5 years, the company has returned 95%, and the S&P 500 has returned 92%, which is actually decent, right? In terms of the last 3 years, it's about 8% total return, and 23 from the S&P 500. So it hasn't done well in the last 3 years. But when you look at the last 10 years, it has returned 242%, okay, and the S&P has returned 157. Now, if we compare this with the likes of the Sherwood-Williams, as well as Linde, which is a new company that I've included in the portfolio recently, and we focus on the last 5 years, okay, you could see our product. I think I showed you this last time when we talked about Linde. Okay, if you haven't seen that, go and watch that video. As you can see, it's actually done better, but it has beaten the S&P 500, and it has actually it hasn't beaten Sherwood-Williams either. But when we look at the 10 years, 242, S&P 500 157, Linde is 275, so not far off. And Sherwood-Williams has actually outperformed both of them by almost to 200%. So as you can see, it's not a bad business. It has done well in the past. Its expectations look good. The dividend absolutely looks solid. So it's really a good business overall. And I think if we look at this, okay, so I have done a couple of valuation models. So I've used the dividend discount model as well as the multiples valuation model. Then I took into consideration Morningstar valuation as well as simply Wall Street, which we've already seen. If you average up the four, you get $343 for the intrinsic value for this business. Current price is 270. That gives us about 27% upside from where we are. If you then say to me, okay, I need about 10% margin of safety, okay, then do that. If you want maybe less than that and you think this company is not that volatile, then your buy price will be 327. Now, if I say this is 15%, this is very risky business and this and that, okay, 292% is still an upside from where we are right now. And to me, it's still a buy. So what am I doing with this company since I actually own basically in the portfolio? And the answer to that question is I'm actually buying more of this business because this is actually the lowest it's been for a while now, because it has come down. Of course, it's been lower, slightly lower than that recently, not long ago, but it has bounced back since. So now what I'm interested is I'm building my material sector, if you like. So I've got Lindsay here, which is very similar to Air Products and Chemicals, way bigger. This one is huge. In fact, is way bigger than Air Products and Chemicals. So what I'm planning to do, inshallah, moving forward is to buy more of these two companies, inshallah, in the coming months. And I'm doing my watch list for the next 3 months, so inshallah stay tuned for that. I'll release that video as soon as I finish the watch list. But yeah, these two companies are two of them on my watch list right now, and of course they have come down quite a bit. So I'm interested in adding more. At least if I can get 20 shares in the next few months, that would be absolutely perfect. Then I can leave it alone and see what happens to the business. But the fact that it has an upside from 27% from where we are now, and every single company that I've looked at so far basically says it is supposed to go do better in the next couple of in the coming year, basically. Right, I'm going to stop the video here. If you haven't joined us on the Patreon account, so if you haven't joined us already, please do so, because it really helps the channel moving forward and so on. And you get access to a lot of these things. You get access to the Discord as well. And if you haven't liked the video, please do, because it takes a lot of time and effort to put these things together, and it doesn't cost you a penny. Okay, just like the video, subscribe to the channel, let me know if you have any questions. And as always, I'm going to try and continue to be as transparent as I possibly can and let you guys know exactly what I'm doing, inshallah, moving forward. Have a wonderful day. Assalamu Alaikum.